session on optimizing your international exposure through a PCC. Without further ado, let me pass you over to Dr. Paul Warman.
Good afternoon and hello to everybody on the call, on the webinar. I'm very much pleased to welcome you to today's webinar, in which we would like to provide you with an idea of how you could optimize your international exposure through a protected cell captive solution. Today's speakers are delighted to share with you our experiences and recent market observations in the current international market environment. We have observed that captive reinsurance companies become in these days more popular across the APAC regions. However, captive owners are mostly large and international operating companies. They comprise of the critical size of an insurance portfolio to finance a fully owned captive as a subsidiary, mostly licensed as a reinsurer. You in the markets have certainly taken notice that captive owners intend to achieve various benefits like transparent and cross-border overview of premium and claim flows, gaining access to targeted risk management measures, which help to achieve improvements in the entire risk management, participation in attractive underwriting results, optimization of local insurance coverages thanks to the captive reinsurance capacity, and get exclusions financed, which are embedded in an insurance policy and ultimately in an insurance program. Development, of course, of balance sheet IBNRs within a captive and getting access to the reinsurance markets. Risk managers of companies which can't finance an own legal entity as a captive are interested, of course, to explore opportunities for similar market choices. We have experienced some market examples of setting up for, say, group captives or an association captives. In those business cases, generally spoken, a risk manager runs a minor equity share of the company. The entire portfolio of such a group captive comprises of the individual exposure of the individual shareholders, which decide jointly on the underwriting policy and appetite. Consequently, the final underwriting profit or loss is a result of the quality of the exposure which has been ceded to such a group captive. In addition, risk managers could seek for the opportunity to use the reinsurance license and infrastructure of a fully licensed third-party reinsurer for a limited time period. Very popular in this regard is a protected cell captive model. Protected cell captives have increased in popularity during the last 10 years in various locations, as in Guernsey and Malta in Europe or Labuan in Malaysia. I've tried to provide you an initial comparison between the reinsurance captive and the reinsurance protected cell structure on the following slide. Shelley, can you please share the slide? What is a protected cell company? This is the first question. It is a standalone reinsurance company consisting of a core and a number of cells, which are segregated from each other. The core cell provides the necessary capitalization and is basically independent of the other cells. The aim of the protected cell captive is to combine the advantages of the rent-a-captive and the single parent captive concept whilst ring-fencing each cell from financial instability of neighboring cells. Both reinsurance captives and reinsurance PCCs rely on a professional insurance company as a fronter. The user of a cell has not to provide a capital injection for the equity for the core. The operational costs for the setup and the maintenance of a cell are much more lower compared to the financing of an own legal entity. A limited usage period of, say, 3 to 5 years allows risk managers to gain first experiences with self-financing instruments and start to develop respective own risk management strategies. A PCC exit decision is more easily to achieve compared to the winding down of an own legal entity. Generally, the lack of substantial equity within a PCC company has led to the business practice of fronters to seek for collaterals in order to cover the exposure which is reinsurance to the cell. Like captive owners who have expanded their buying behavior from the non-life line of businesses to the EB life world, a user of a cell could potentially explore the inclusion of EB life reinsurances as well. I'm now highly interested to learn from a very well-known European PCC expert how a PCC solution works in detail and why more and more European risk managers get excited about this journey. Malcolm, please, over to you.
Thanks very much, Paul, and thanks for the introduction to the Protected Cell Company. Well, having been in Guernsey when the PCC was created, I find it quite amazing that next year we're going to be celebrating the 25th anniversary of this structure. So what have we learned in those 24 years to date? Well, first of all, this is a global phenomenon. Although it started in Guernsey, the PCC legislation has been copied across the world, and the US is probably the major adopter of this. Labuan in Asia has adopted it. Interestingly, Singapore has not adopted it for insurance structures, and I wonder whether they may have missed a trick by ignoring that. But anyway, it comes under a variety of different names, but the concepts that Paul explained remain relevant to all of these named entities. So how did the PCC come about? Well, quite unusually, it was a regulator who came up with the idea, a gentleman called Steve Butterworth, who at the time was a regulator in the Guernsey Financial Services Commission. And if we move on to the next slide, he had a couple of scenarios in mind that he thought some sort of structure like a PCC may be able to offer a solution, although he didn't really know what the PCC concept would develop into. He just wanted to put down a basic and enabling legislation, and then was confident that the insurance industry would be able to take this concept and apply it to real life situations. So the two scenarios he was thinking of was firstly a large conglomerate that would have a large number of subsidiaries performing various functions. Some of them would be insurance related, some of them would just be normal administration associated with a large conglomerate. And he had the idea that you could put all these functions into separate cells, but they would all fall within one company, one PCC, thereby reducing cost and making the administration a lot easier because you wouldn't be running a number of individual companies. And I think the original example he used was the Virgin brand. And then the other area he was sort of pondering over was when he was in Cayman, there were a lot of medical malpractice groups, captives set up. And he was trying to think of a structure that would allow a number of small individuals to be part of a larger risk retention vehicle. And here you can see the example is that each doctor in a medical group would have their own cell, which would have the retention of their malpractice cover. But the whole thing would be coordinated and managed by the medical group. So those were the sort of concepts that Steve had. let's see, 24 years on, let's see what the reality looks like. I'm not able to give you the stats at the end of 2020 for Guernsey, unfortunately. But if we look at where the position last year, you can see that the protected cells and the protected cells companies absolutely dwarf the number of standalone captives. And if we then include the incorporated cell companies, which are effectively a spin-off of the protected cells, then you can see that by far most of the risk retention vehicles in Guernsey are the protected cell type structure. So what caused this success? Why did they overtake captives, and why have they become so popular? If we can use an analogy, I like to think of a captive as a sort of standalone detached house, and a protected cell as an apartment within a block of flats. So the captive, you obviously own the house, you have full control of the property, you're responsible for the maintenance of that property, but you can select who you want to maintain the house, and you can do what you like with the house. It's yours. You can have parties, you can do whatever you like. The protected cell is more like a flat in a block. You have ownership of that flat, but obviously there are a number of neighbours, and you don't necessarily know who those neighbours are or whether they're noisy or not. Typically, there are some rules that you have to sign up to be a resident within that flat. So you don't have full control. For example, you may not be able to put washing on your balcony or things like that. And typically, there's a management company that will be responsible for the maintenance, and then you will be responsible for a proportion of those costs. So the costs are lower, but you have less control over what's happening. And that's very much the scenario with a captive and a cell. A captive, you know, it's a wholly owned subsidiary. You have full control of your vehicle. A protected cell, you have control of your cell, but you don't have control of the protected cell company in which it sits. But most organizations find that the advantages of the PCC far outweigh maybe some of the disadvantages. So let's have a look at how these cells have been used. Well, the main use of them is very much how Paul was describing earlier, in terms of acting as a mini captive or almost a renter captive, in that an organization that may not feel it's large enough to have its own captive, but is able to set up a cell within another protected cell company and can operate it the same as you would with the captive. And typically these are fronted. So an organization like Zurich will be writing the risk in the particular territory and then passing that risk into the cell. Another use is, with the market being so tough at the moment and capacity and pricing being difficult, a number of organizations are looking to access the wholesale market, the reinsurance market. And so they're using a cell effectively to translate the risk from an insurance risk to a reinsurance risk. Certainly in Bermuda, these cells have been used a lot to move insurance risk into the capital markets. And you've probably heard of cat bonds and ILSs, sidecars. These are all transactions that are using cells to basically take the insurance risk and move it into the capital markets. Another use, which probably wasn't anticipated at the beginning, was to allow each individual cell to act as a separate life insurance policy, and the assets supporting that insurance policy are maintained in the cell. Another interesting use has been the ability of the protected cell company to access disaster pools. And I'm thinking here of terrorism, and I suspect with the pandemic, there will be governmental pools established. And by using a cell of a protected cell company that wishes to be in these pools, you can get access to that relief. And there are some PCCs that are created that aren't members of these pools. So if you don't want to be in them, then you can avoid joining them. ICCs, incorporated cell companies, are really just a spin-off from protected cell companies. The use of the protected cell company is interesting because it's spread from insurance into the investment world, and now cells are used as sub-investment funds. So it has a broader application than just insurance. And finally, one vision that Steve Butterworth had was the ability for these cells to sort of move from one protected cell company to another, or to become a standalone captive in its own right. And whilst that is possible, to date, we haven't seen a great deal of movement. I think most organizations, once they have a cell, they're so comfortable with it and it works so well that they really don't see the need to change it into something different. So again, just drilling down a little bit more in terms of how these cells are used. The main issue, I think, is that it makes the use of a captive available to companies that may have thought they were too small or their premium spend was too low to afford a standalone captive. So it's been a great benefit there to the SME market that allows them to adopt a much more structured risk financing strategy that they may have felt that they couldn't do that. And as Paul has explained, the cell can act as a reinsurer, or where it's permitted, it can write the business directly. And that risk can be either domestic risk, or if your organization has entities in various territories, then it can write it on an international program. With the market being so tough at the moment, certain risks like credit and professional indemnity, we're finding that the markets are asking for larger excesses. And so one of the uses of the cells really is to finance the increased deductibles that companies are being asked to carry. And finally, a use of the cell is for customer insurance. And in fact, we're going to have a case study on this later on in the presentation. So, you know, how does it work? What do you have to do if you have a cell? Well, it's a bit similar to setting up a company in its own right. There's an incorporation of the cell. A bank account is opened because the funds in the cell are separate from every other cell, so you have that protection. And the user of the cell will have to put some capital in, not as much as a standalone captive, but a small amount to meet solvency. There are some agreements that have to be signed, and basically they just lay out the roles and responsibilities of the various parties. You as the cell user, and the owner or sponsor of the PCC, and if there's a management company that's looking after the structure, then that will all be incorporated in agreements just outlining who does what. And once that agreement is signed, it's normally ongoing, but there are termination clauses so that you can leave the protected cell company if you're, for whatever reason. And the cell owner has shares in the cell, but they're typically non-voting in the organization. So we look to the owner or the sponsor of the PCC to establish the board, to arrange the management of the structure, and arrange external auditors. As a cell owner, you would receive regular management information. You would receive obviously confirmation of coverages being written by the cell. You would get management accounts, and you'd see the audited accounts of the PCC. But because you don't control the whole of the PCC, you would still have to look to the board to approve your business plan. And if you had profits in the cell and you wanted to distribute them by means of dividend, you'd have to get their permission before you did that. Having said that, I've never heard of a dividend request not being accepted. And it is possible to set up an advisory committee of the cell, and in turn you can make recommendations for the PCC board to consider. So whilst you don't have direct control, you will certainly have a significant influence. So the key here really is, I think, to do your proper due diligence of the sponsor of the PCC to make sure you be comfortable entering into a relationship with them. And the last question really, and this is built on experience before protected cells came into effect. There was a structure called a renter captive where you effectively rented capacity in someone else's insurance company. And unfortunately, there were a few failures of that structure. So is the cell any safer in terms of your risk and your assets? Well, the first thing is because there are PCC legislation, and that dictates that each cell is ring-fenced and segregated from the others, you have the comfort of knowing that there is legal protection as well as contractual protection. As I mentioned earlier, each cell has to have a separate bank account, so your funds are not commingled with anyone else's. They are completely separate and cannot be accessed by anyone else. As a further protection, it's recommended that you keep your cash and your assets in a jurisdiction that recognises the PCC structure, so there's less chance of the court trying to seize those assets. But at the end of the day, although we're 24 years down the road, there really hasn't been substantial case law to confirm that the structure is robust. I suppose you could look at it, the fact that there hasn't been case law means that the structure has worked so well, there's been no need to resort to court action. But anyway, it's been a great success. No one really knew what was going to happen when they set up the PCC structure, but the industry has shown how adaptable it is and applied that information. So that's a quick run through the practical side of the PCC. I'm now going to hand over to Farah.
Thank you, Malcolm. I'm just going to go through, I know the slides are going to be sent across to everyone, so you'll have the benefit of that. But I just wanted to start very basically about where Labuan is before we go into the PCC structure that we offer. So north-west coast of Borneo, part of Malaysia, a federal territory that comes directly under the purview of the Prime Minister of Malaysia. Easy access from Kuala Lumpur, Kota Kinabalu, population of about 100,000. Oil and gas is a huge economic driver. So is the IFC, that's 30 years old as of last year. So it's organically grown. As a jurisdiction, it's organically grown. It's been around for 30 years, and we have a whole suite of legislation that I'll walk us through. So 30 years of intermediating Asia, really how we position ourselves compared to other jurisdictions is that we look at ourselves as a mid-shore center. We're not your traditional offshore center. We would like to think that what we offer is the stability and the regulatory reputation of an onshore center, but with the flexibility and the bespoke service as well as the wholesale structures that you would find in a traditional offshore center. So the governing legislation that really creates the center is passed by the Malaysian Parliament and is administered by the Labuan Financial Services Authority, which is a statutory authority directly under the purview of the Ministry of Finance of Malaysia. Yeah. So what's important to understand is that our KYC, our Know Your Client and anti-money laundering rules are the same as Malaysia onshore, and it adheres to international standards. So for the longest time, unfortunately, Labuan was banded together with other more typical jurisdictions, offshore jurisdictions, I should say. But to be honest with you, we've never accepted and we've never had the business modules or the business processes that a traditional offshore center had. So the reason Labuan grew in the first instance 30 years ago was because the Malaysian government felt that it was important for Malaysian companies as they expanded to have a neutral jurisdiction to use as they went offshore, as they went global, as they went regional. And since then, from a ratio of, let's say, 70% domestic users of Labuan IBFC, we now have a ratio of 60% foreign users. of Labuan. So really it's grown from being an organically driven jurisdiction for the use of Malaysians to a more regional jurisdiction for the use of all. So these are the laws and the acts that really create the IFC. Yeah, and it's interesting to note what Malcolm talked about in the sense that the protected cell company that we offer in Labuan does not sit within a traditional insurance act. In fact, it sits within the Companies Act of Labuan, and it does not only apply to insurance needs. It applies to wealth management funds as well as insurance. So very much like the Singapore VCC, the Labuan PCC can be applied for wealth management requirements or wealth management needs. But unlike Singapore, we also, and we encourage and we also allow the PCC to be used for risk management requirements. In fact, as we morph, new guidance will come out with regards to our self-insurance regulations by the regulatory authority, possibly by the middle of this year, which hopefully, fingers crossed, will allow for the use of wealth management, fund management, and risk management within one core. Yeah, so that will be quite interesting. That will be another first. As it stands as of today, Labuan IBFC is the only jurisdiction in Asia that offers the protected cell company for insurance purposes. Again, going back to the organic growth of Labuan has allowed us to offer a complete ecosystem of solutions. So what we have in Labuan is everything from banking to capital market solutions. The digital or fintech space, DLT space, is fast growing for us. And insurance is actually, to be honest with you, the fastest growing vertical within Labuan. More details to come. So the self-insurance proposition within Labuan is really quite wide. We not only offer single cell captives, we also, well, as in pure single owner captives, multi-owner captives are also allowed, group or association captives are also allowed. We have rental captives and we have protected cell captives. And I think once we debut our new guidance soon, well, middle of the year, hopefully, you will see the introduction of other more flexible as well as innovative uses for self-insurance vehicles in Labuan. This is the slide I wanted to talk you through a little bit because this really shows you the depth and the breadth of the Labuan insurance environment, the ecosystem. At the moment, Labuan is home to 221 license holders in totality. It is the largest. In total, Labuan is home to about 900 license holders. We have about 60 banks, about 60 to 70 trust companies, which is company secretaries that operate and offer Labuan. We have an array of Islamic finance vehicles and structures. We are home to wealth management vehicles from trust to foundations. But the Labuan insurance industry is home to 221 licenses, 55 captives, 79 brokers, 64 reinsurers, and 23 managers. Now, what's important to understand is I think that when you start looking at captive structure, whether it be a PCC or a single owner cell, what you need is an entire ecosystem to support you. Unlike other more box standard, I should say, reinsurance vehicles, let's say a broker or reinsurer, that in most instances are able to stand alone and have corresponding needs outside the jurisdiction. Captives tend to require a lot more assistance. So our insurance managers are on board to help you. The bankers are well aware as to what's required for bank account opening vis-a-vis captives or cells. The reinsurers are there to assist you, and so are the brokers. We find that in a lot of other jurisdictions, what happens is that you have a protected cell company structure, but it sits within a vacuum. And that is essentially what is not required and what hinders the growth of that cell. Because as Malcolm says, a lot of instances, what happens is the cells are a bit like training wheels to a pure captive. And once the companies or the risk managers are more accustomed to using a cell, they want to graduate. They want to graduate into a full single parent captive. And that's where really the need for an entire ecosystem kicks in. So in 2020, I can share with you that we've had 8 new captives in the jurisdiction, 6 of which were PCCs. I think a lot of it has got to do with the hardening market, as everyone's talking about. But I think a lot of it has also got to do with the fact that there's more awareness with regards to self-insurance, and there's an appreciation with regards to the cost efficiency of cells compared to single-parent captives or pure captives. I think, my layman's view of it, in a way, because I'm not an insurance professional, unlike everyone else on the panel here, is that I look at it as the democratization of self-insurance. And in Asia, as you know, we are extremely cost sensitive. So anything that's able to allow the risk managers an opportunity to taste what it's like to really manage their risk at a wholesale level, they will take to. So this is why we believe very strongly that PCCs will be the way forward towards enhancing risk management attitudes within Asia. We have 7 commercial captives, and we know that in the pipeline, I can share with you that we already have another 8 in the pipeline for 2021 already, as the runway from 2020 going into 2021. My chats with the regulators have indicated that we already have 8 in the pipeline coming on board for 2021. So in the third quarter of 2020, captive insurance attributed to more than 30% of the gross premiums. And we really believe that Labuan is the leading jurisdiction, or the leading growing jurisdiction in the space of self-insurance. And we believe that the PCC structure will be what will push us through to another level of leadership in this space. So I think Malcolm and Paul had spoken about the structure of the PCC. So, and Malcolm's analogy to a condo is fantastic. What's important to understand and appreciate really is that box standard PCCs run the world over. And what is really important is the fact that each cell is bankruptcy remote. And this is provided by legislation. So Section 130, as subsection 3 of the Labuan Companies Act, provides for this. Yeah, so that is the bankruptcy remoteness and the protection that each cell enjoys is statutorily provided. And I mentioned about the cost efficiency earlier. We also offer master renter captive and subsidiary renter captives as part of that. So this is just something that you can go and look at later. So why Labuan for your captive domicile? We are your only domicile in Asia. Having said that, we don't rest on our laurels. So as you know, we'll be fine-tuning our proposition. There's a whole slew of reasons, but I think one of the most important reasons is the fact that captives is a wholesale offering. And with a wholesale offering, you want a bespoke regulator, a one-stop regulator that will be able to handhold you in this process. And that's what we offer. Currency neutrality, legal neutrality, tax efficiency is something that's important. But the fact is, at the end of the day, it's a facilitative all-round regime that we offer, and that will be able to assist you in your risk management journey. So thank you for your attention. I've taken up my 10 minutes. Next, can I just invite Paolo to talk through his experience as a risk manager and a PCC user? Thank you very much.
Thank you. Thank you, Farah. And good morning or good afternoon, everybody. I'm based in Europe, so it's morning my time. Paul, Malcolm, and Farah has highlighted the characteristic of a PCC solution respect a captive solution. Now, with you in a few minutes, I will bring you into Amplifon experience with such a solution. But first of all, let me introduce Amplifon just to also to give you some more insight that can be useful in understanding why the PCC solution has been a very positive experience for us and solve a series of business issues that we have. Amplifon is the worldwide leader in the hearing care retail market. And Amplifon is present in 5 continents, 28 countries, and operates through a network of more or less 11,000 shops and 17,000 employees. Hearing aids business is a niche business in the high-tech medical device and has some particular features. I start with an example. I think everybody of us, as soon our eyes will start became weaker, we immediately go to the opticians and buy lens without any kind of problems. On the other hand, people that start feeling to be hearing impaired do not immediately react. The decision to buy an hearing aid is a decision that often takes some years. And then when you finally are convinced that you need the hearing aids to improve the quality of your life, then you go to the retailer, you go to the audiologist, and discover that these small high-tech medical devices are very, very expensive. And elderly people are a little bit worried about the possibility to lose them, about the eventual possibility that their dog will bite them, and so on. And so to pay some thousands of dollars and having the risk to lose high value and small equipment can be a further constraint in the decision. And thus, for us is very, very important to have the possibility to deliver the customer an insurance, for instance, loss and damage, extended warranties, and so on, that with a small additional price keep them saved against the risk to lose this small hearing aid. And then due to the fact that they are particular high-tech medical device, our customer are elderly people and so on, also the characteristic of this insurance should be really tailored to our business. On the other hand, such cluster of customer pay a lot of attention to their belonging, and it's really unusual that they lose the hearing aids or the hearing aids will become damaged. So this kind of insurance is also really profitable. So we really need to have a solution to provide the business and to help the customer. But we are delivering hearing aid services. We are hearing aid retailer. We do not have in our history, in our background, insurance experience. And manage an insurance business for listed companies, especially for a listed company, means to be able to manage the insurance business, first of all, fully in compliance with all the applicable regulation, and also to be able to manage the intrinsic reinsurance risk. Means we need professional. So the question is, we have to manage this insurance business through a pure captive company, or then talking with Zurich and with other expert and broker in the system, we discovered this PCC structure, but we were thinking absolutely initially to a pure captive. The pure captive has a series of issues. So we needed to have a insurance manager on board. We needed to have experience. We needed to create a company with a significant capital requirement. We needed to learn how to comply with all the insurance regulation. While through the PCC, we had a structure that they allow us to have an immediate start. Of course, we have to open the bank account, to pay the share capital that, however, is very, very limited. In our case, it was 1 million euros, just for your information, and to appoint the the board member and so on. But immediately, in a couple of weeks, then we have been able to start, and we are with Zurich. We have been able to design the solution, and also has been important our collaboration with Zurich, because of then the cell is based in a particular geography, in our case in Malta, but then the policies, the insurance are sold all over Europe, and we need to comply with the different regulation in the different countries. Insurance is a market that is highly regulated. So with Zurich, we had the possibility to tailor the proposal to each single European market regulation in a very easy way. And another important topic was that this structure also allow to share a portion of the risk with Zurich. The business is profitable, so we chose to have Zurich on board with a small portion, but this helped to have also Zurich really committed and to work together to the success of this solution. Another important aspect is that despite the cell is a portion of a biggest company, this particular structure under IFRS, considering the implementation of some governance rule, allow the consolidation of the cell figures in the group financial, and this for a profitable business is really important. So having said that, I move to Adrian, that will introduce us the tax aspect of this proposed solution.
Thank you, Paola, and good afternoon, everybody, or good morning, wherever you may be. So, in the next 5 or 10 minutes, I would like to share the typical tax considerations to be considered in a PCC project. I say considerations, not answers, as this depends both on the PCC structure in question and the laws of the foreign parent jurisdiction. So, the first question to ask is the following. For tax, is a PCC the same as a single owner captive? And when you look at this slide, then you will see that I've drawn it to show that the two structures look very similar at the first glance, because you still have your foreign parent, you still have your operating companies, and they pay the premiums and they get claims from something which is in the same economic group. However, when we then look a little bit more in detail at the bottom right part of the diagram, then we see that the captive is, single owner captive is a subsidiary, versus we've drawn the PCC here as a hectagonal, a honeyworm comb structure consisting of core and cell. So the question becomes, how does this then change the tax treatment, given the fact that the economics still look the same? Here we drill down a little bit in what the actual structure looks like. And what I want to show with this graph here is, if we now look at the PCC structure on a more granular level, we notice two key differences from the classical captive concept. First, in the PCC, the foreign parent obtains an economic interest in the PCC, in the new cell, but not in the core. Hence, cell part of the blue group, rest part of the green group. By which I mean to say that the cell is economically yours, but legally part of the PCC owner structure. The second difference, and we see that in the diagrams going from the foreign parent or from the foreign parent to the new cell, is a consequence of the first point. What exactly is the nature of the economic interest you are getting in the cell? Are you getting an equity interest, such as a type of shares, or is it more like a contractual arrangement, like debt financing or providing a guarantee? Now, to go back to my initial point, the answer to this question depends both on the PCC legislation in your chosen PCC domicile, but also on the tax rule in the foreign parent's jurisdiction. Nevertheless, there are some common issues and some common differences this means to the treatment that we're used to for single owner captives. On this slide, I have listed a number of the typical tax considerations when considering both the captive and PCC. In the interest of time, I want to highlight the key areas where the tax treatment differs and not the similarities. So the points that I've marked in red here. Firstly, the substance requirements. Substance requirements are important, both for the insurance arrangements to be respected, so that a premium payment is a premium payment for tax, and also to benefit from Labuan's attractive tax rate. Substance means people and therefore is expensive. It can be hard for small single owner captives to meet substance requirements, and that is one of the reasons for the trend to larger captives we observe worldwide. The good news is that as your cell is part of the PCC with its core and the other cells, you should be able to rely on the substance of the entire PCC, not just your cell, which of course makes it easier to demonstrate adequate substance. The second point to be made is to understand whether the economic interest that you get in the cell meets the requirements to be considered equity in the foreign parent's jurisdiction. Why do we care? Apart from the accounting considerations that Paolo already talked about, from a tax perspective, this may be crucial to understand your exit strategy from a tax perspective. If this interest qualifies as an equity interest, then you may be able to benefit from a tax exemption on the dividend or the capital gains repatriation. This requires careful analysis in the planning phase, as the requirements for dividends and capital gains are not always the same. So it may well be possible, for instance, that you could qualify for a dividend, for a tax beneficial dividend, but not for a tax beneficial capital gain. Obviously, by knowing this, you can actually model your expected tax numbers over the entire life cycle of the cell and plan your exit strategy. I hope these few observations on tax are useful to you. And with that, I'd like to hand over to Steve for the Q&A.
Well, that's great. Thank you very much, Adrian. I got a bit of a warm-up question first, and I want to ask Malcolm and perhaps Adrian as well, and anyone else who wants to comment on this. Malcolm, I love the analogy of the apartment and the house that you own. Let me be quite brutal about this. You know, you're in your apartment, and turns out you've actually got a whole den of drug dealers upstairs, and you have a huge fight, and you don't like them anymore, and your building management company turn out to be a bunch of people you don't like either, what am I going to do? I mean, if I'm in a detached house on my own, I can just sort of work it out somehow. But if I'm part of this arrangement with everybody else, how easy is it to exit? How fast can I exit? How quickly can I go somewhere else? You mentioned there'd been very little case law in this whole area. Am I stepping into the unknown totally here? I'd appreciate your input, please.
Okay, well, I suppose the first option is to go and join the party, become one of the drug users. But as I mentioned, when you set up a cell and you join a PCC, it's important to do the due diligence just to make sure that you're working with organizations that you're comfortable working with and their culture fits yours. And based on that, they should be vetting any other cell user the same way as they're vetting you. So hopefully you're not going to be next door to a drug dealer. If things don't work as well as you would like, then there is as I mentioned, a shareholder agreement that lays out the responsibilities of the various parties. So if you feel that the other party is not upholding their legal requirements, then you do have redress. And I suppose ultimately, if it doesn't work out, then you can give notice that you wish to leave, and then you can withdraw from the PCC. The only caveat is that if you have risk in the cell, and for example, if it's a long-term policy you're writing, you will need to demonstrate that you've transferred or you've eliminated that liability before you'll be allowed to leave the PCC structure. But there are organizations that will buy those liabilities, or if Zurich were the fronting company, it's quite likely that they may be willing to commute the policy and take the risk back in-house. Once you've then got effectively a shell cell within the PCC, it's relatively easy to wind it up.
Thanks. That's very helpful. Adrian, is there anything you would like to add on the tax and perhaps other aspects of that? If you really had to get out of this in a hurry, what are the things that perhaps clients should think about now before that? I mean, it's only good risk management, really, isn't it?
I think it really comes back to the point I made earlier about exit strategy. I think you need to plan these things. And the one thing that you don't want to find yourself is in a situation where after 10 years, you have amassed a huge amount of profit, there's very little risk left in the captive, and you don't know how that exit is going to be taxed, right? So it all comes down to questioning and managing it over the life cycle. And this with all structures, it is not just a question of putting something into place at the beginning. It actually needs monitoring and adapting as you go along and as you grow and as your requirements change. Okay,
that's clear and helpful. Thank you. Just referring into the chat, we had a question fairly early on, actually, from someone called Alistair brackets guest close brackets, who said, did I miss comment on funding the risk gap of the cell? Can you explain how owners finance the cell limit? I'm not sure who'd like to tackle that, whether that's a question for Paul or a question for Malcolm, but I shall throw it open to you guys as to who comes off mute first. Malcolm's got his hand up, Paul. You'll have to be faster than that.
Yeah, so this is reasonably common that if you're going to use a cell, you need to be able to demonstrate to the owner of the PCC that the cell business plan is sensible and that it's adequately funded. And typically what will happen is there will be a requirement to show that you have sufficient assets to meet a worst case loss scenario. And if that is the case, then you may not need to put capital into the cell, but you need to demonstrate there is a source of funding that will meet any shortfalls should the premiums be insufficient to meet the losses. Now that could be a letter of credit, it could be some sort of promissory note, or it could be a loan or something else like that. But that really is a commercial decision between the cell user and the PCC owner. If you have a very well-established piece of business with a track record of performance, then probably the PCC owner is going to take a more commercial and pragmatic view in terms of the amount of funding, because they have a high degree of comfort as to how the business will perform. And certainly if you have an actuarial analysis telling you what the likelihood of the outcome is going to be, again, that should add comfort to the PCC user. But, you know, to go back to some of the points made earlier, the whole intention is that the cells are self-funding and that they are completely segregated from any other form of finance within the PCC. So it's important that the business plan is robust enough to demonstrate that you meet those maybe unforeseen scenarios.
Right.
Thank you.
And I may add, probably, I mentioned in my introduction that Zurich's policy, our policy is, especially for cells which have just started, that we ask for collaterals in order to finance the gap between premiums and the exposure which gets reinsured to cells. This is our policy.
Thanks, Paul. Appreciate that. Anyone else want to add anything on that one, or should we move on? I think perhaps we move on. So I have another question in the chat from Andy Tan. Thank you, Andy. Can PCC be used to host different programs and different shareholdings for the programs? So again, we're getting into that legal complexity again. Who'd like to address that one, please?
So from a business point of view, yes, we have seen cells where we have seeded various line of businesses in one cell. This we have seen, of course. We have experienced as well that cells do generally starting with short tail business in order to avoid complexity, which was mentioned by Malcolm when it comes to run of business, or which were addressed by Adrian. From an internal point of view with regards to shareholder, I would like to move over to Malcolm probably.
Thanks for that hospital pass, Paul. Yeah, I mean, the PCC structure is pretty flexible. So if you want to have multiple owners of a cell, that's possible. If you want to put different classes of business into different cells, that's possible. I suppose the way I would look at it, and again, another analogy, is to look at the syndicates at Lloyd's in London, where each year the syndicate is slightly different in terms of who's participating in terms of putting capital and capacity in, and the risks that the syndicate are writing each year may be different depending on the appetite of the underwriter. But so effectively you can replicate that flexibility within the PCC structure, and you can issue new classes of shares for each cell. So you can issue those to multiple owners, or you can set up separate cells, as I say, for different lines of business. So anything you can do with a captive or a traditional insurance company, or even what you can do at Lloyd's with the syndicates, you can do within a PCC.
Thanks, Malcolm. That's helpful.
May I ask you, Steve, something? I heard that you have got some experience with the life world, so this might be of interest for the participants to get a feedback if this is right, that cells can be used as well for the life business, EB life programs, please.
Well, thank you for that unprompted question. Yeah, I basically helped establish a PCC in the US just over a year ago, and that was entirely around employee benefits. So actually, the process was very smooth, very straightforward, and everybody concerned was comfortable to the point at which, after the first year of operation, I've effectively exited the process, because they can pretty well run it on their own. It's pretty easy. They don't need me looking over their shoulders anymore. So no, it was a very straightforward process. Thank you.
Thank you.
Farah, I was going to come and talk to you a little bit about, that's in the US. And
sorry, you kind of broke up there, Steve. Did you say the advantages of Labuan vis-a-vis the PCC, or?
Yes, and any potential barriers you might see for growth in Asia.
I think for as long as Asians remain cost sensitive, it's just generally the idea of getting the idea of a PCC and the comfort. I think a lot of people try to understand the PCC from an insurance perspective, but really, maybe because I'm legally trained, I look at it from a corporate point of view. It is essentially just a structure. It is a company that you own that is managed by someone else. So it doesn't matter what you put in it, right? And that's one of the things that we require. So we require a separate business plan for each cell to be submitted, right? So that we understand what's going on within that cell, whether you are with some drug dealers or not, as it were. So that's the bit that's important. I think the growth of PCC in Asia, in Labuan specifically, is the fact that people are starting to understand that this vehicle exists. People understand that self-insurance is no longer necessarily an expensive exercise. And also the idea that you are able to kind of use these structures as training wheels, and that there is the bankruptcy remoteness as opposed to rent-a-captives. Rent-a-captives have been available in Labuan for the longest time, but they didn't really take off because it then falls back onto the agreements between the master and the subsea. But with a PCC, it's statutorily provided. That bankruptcy remoteness is statutorily provided. And then I go back to what Malcolm said about case law. Maybe there isn't a need for case law because it is provided by statute. So once that protection is there and people appreciate that protection is there, and that's why it's so essential to remember that fact, that what you have is a little captive that you can then use, experience before you move on to something bigger and greater. And I think that will allow a taste, like a degustation of sorts, before you have a full meal, as it were. So really, I think in Asia, as the recognition for self-insurance grows, as the market gets harder, unfortunately, as the pandemic doesn't seem to abate as yet, we are going to see further and further growth.
Thanks, Farah. We've been beaten by the clock, definitely. But Paolo, I just wanted to come to you for a last comment and a last thought. You gave a very clear explanation from a risk manager perspective, where you had a specialized need, you understood the need extremely well, and the PCC solution fitted that need perfectly the way you've explained it. If I could roll you back, if PCCs had not existed or had not been an option or had not been something you'd known about, do you think you would have built a full captive solution to seize the same business opportunity? Or would you just have thought about that opportunity in a completely different way with Zurich and your other partners?
Before the PCC, we had a captive, a real captive solution. But then this captive worked with reference to only just one market in Europe, Netherlands, to be explicit. When we wanted to increase the business to cover all Europe, we discovered that the captive solution is really expensive, not only in terms of capital requirement, but mainly in terms of what we need to do the right things. We are very skilled in selling hearing aids. As said, we are not insurer. And if you want to run each business in your group in the way this business has to be run, you need, or you are very, very big, and so you can invest millions, perhaps some tens millions of euros. And hiring people, creating big company with capital structure, a lot of dedicated teams and so on. Either if your dimension is not so big, it's really expensive. I don't know. We discovered the cell during this process where we were exploring how to increase the captive business. Then we have been told of this. We do due diligence, we do tax analysis, and so on and so forth, and we see a series of advantages in this solution. So we move. Perhaps if the cell would have not been a possible solution, we would have gone with the captive. But for sure, this for certain kind of business, the possibility to offer to the customer this personalized insurance solution is really important.
Excellent. Thank you very much, Paolo. I really appreciate your insights, and thank you everybody else. Most of you are still on the call, so thank you for your patience, even though we're a bit longer than scheduled. It just really remains me to wrap things up for everybody. There are no more questions in the chat at this stage. Thank you to Zurich for arranging all of this and inviting Parima to participate.